Hello and welcome to our news video. Subscribe to our channel and share your comments so that you don't miss any important news. Solana, SOL, price faces downward pressure amid declining on-chain activity and market sell-off. IRS seeks dismissal of crypto executives' appeal over financial record summons. Franklin Templeton's Solana ETF move and SEC's legal strategy shift. US and UK opt out of global AI ethics agreement amid regulatory concerns. US, UK, and Australia impose sanctions on servers for alleged support of Lockbit ransomware operations. Solana, SOL, price faces downward pressure amid declining on-chain activity and market sell-off. Solana, SOL, is experiencing a notable price decline, reflecting broader market trends and diminishing engagement in its decentralized finance (DeFi) ecosystem. With SOL prices slipping over 6% within 24 hours, various factors, including macroeconomic conditions and weakening blockchain activity, are contributing to its bearish momentum. Macroeconomic factors weigh on Solana's price. Solana's recent price drop aligns with a broader sell-off in the cryptocurrency market, following remarks by U.S. Federal Reserve Chairman Jerome Powell. During the Senate Banking Committee hearing on February 11, Powell's hawkish stance on interest rates triggered uncertainty across financial markets. Key takeaways from Powell's speech include: the Federal Reserve sees no immediate urgency to adjust monetary policy. Cutting interest rates too soon could reverse progress on inflation. Delayed rate cuts might negatively impact economic activity and employment. The probability of maintaining current interest rates in the Fed's March 19 meeting has risen to 95.5%, compared to 75.5% just a month ago. A rate cut is unlikely before September 2025, and fewer than 2 cuts are expected for the entire year. Following Powell's remarks, both short and long-term U.S. Treasury bond yields remained elevated. As a result, investors are finding fixed-income assets more attractive, leading to reduced demand for riskier investments, including cryptocurrencies like Solana. Declining on-chain activity weakens Solana's demand. Solana's price decline is not solely attributed to macroeconomic trends, it also reflects reduced engagement within its blockchain ecosystem. Data from June analytics highlights a significant drop in network transactions, signaling reduced user interest. Key figures: the daily transaction count on the Solana blockchain fell from an all-time high of 71,738 on January 23 to just 23,835 by February 12. This sharp decline in network activity indicates lower demand for SOL tokens, as fewer transactions typically translate to reduced economic activity within the ecosystem. Additionally, Solana has been significantly impacted by declining enthusiasm for memecoins, which played a crucial role in driving its bull run in early 2024. The total market capitalization of Solana-based memecoins currently stands at approximately $11.15 billion, a sharp contraction from previous highs. Official Trump, one of the largest Solana-based memecoins, has plunged 80% from its peak. Broader weakness in the memecoin sector suggests a fading speculative interest, which previously fueled significant network activity. This downturn in memecoins has further reduced investor appetite for Solana, contributing to its ongoing price weakness. Technical indicators point to a potential 40% drop. From a technical perspective, Solana's price chart exhibits a head and shoulders (H&S) pattern, which could signal further downside. Key technical insights. The H&S pattern consists of three peaks: a higher central peak, head, flanked by two lower peaks, shoulders, with a support level, neckline. The price target is calculated by measuring the distance between the head's peak and the neckline, then subtracting that distance from the neckline's breakdown level. As of February 12, SOL appears to be forming the right shoulder of the pattern, with critical neckline support at $180.50. A breakdown below $180.50 could push SOL toward the H&S target of $109.21, representing a 40% decline from current levels. However, if Solana holds above the neckline and regains bullish momentum, it could attempt a recovery toward $215, invalidating the bearish H&S setup. Final thoughts. Solana's current downturn is influenced by multiple factors, including hawkish Federal Reserve policies, declining on-chain activity, and weakening speculative interest in meme coins. While the technical outlook suggests a risk of deeper losses, a sustained hold above key support levels could provide a foundation for recovery. The coming weeks will be crucial in determining whether Solana stabilizes or extends its downward trajectory. IRS seeks dismissal of crypto executives' appeal over financial record summons. The U.S. Internal Revenue Service, IRS, has urged a federal appeals court to reject an appeal by crypto entrepreneur Roland Marcus Andrade, who claims the agency improperly summoned his financial records without proper notification. The IRS maintains that it complied with financial privacy laws and followed the required procedures in its investigation of Andrade and his firm, ABTC Corporation. IRS pushes to dismiss Andrade's appeal. In a legal filing on February 10, the IRS, alongside the Department of Justice, DOJ, asked the Fifth Circuit Court of Appeals to dismiss Andrade's attempt to quash the summonses issued against him. The tax agency argues that the court lacks jurisdiction since there was no active legal proceeding in the original case, which was filed in federal court against Andrade and ABTC Corporation. The IRS launched an inquiry into ABTC Corp to determine whether the company had violated financial reporting laws under the Bank Secrecy Act. During the investigation, the agency requested Andrade's personal financial records, suspecting his involvement in the firm's financial dealings. However, Andrade contends that he was never properly notified of these summonses. IRS summons led to legal dispute. The dispute dates back to 2021, when the IRS began investigating Andrade. In May 2023, the agency issued summonses to Bank of America and JP Morgan Chase, seeking financial documents tied to Andrade and ABTC. However, Andrade argues that the IRS failed to notify him as mandated by the Right to Financial Privacy Act, RFPA. Key developments in the case. September 2023, Andrade's attorney learned of the summonses and requested copies from the IRS. October 2023, the IRS reissued the summonses with proper notifications sent to Andrade's business address, but they were returned as undeliverable. February 2024, Andrade filed a lawsuit in Texas, demanding the court invalidate the summonses on the grounds of privacy law violations. In May 2024, a district court ruled against Andrade, stating that the IRS had followed RFPA requirements by reissuing the summonses and making efforts to notify him. The court also determined that the case was moot, as the banks had already complied with the summonses and handed over the financial records. Appeal to the Fifth Circuit and IRS response. Unwilling to accept the district court ruling, Andrade appealed the decision to the Fifth Circuit in August 2024, seeking a stay order to prevent the IRS from using his financial records while the appeal is pending. In its latest filing, the IRS and DOJ countered Andrade's claims, asserting the IRS substantially complied with RFPA requirements. Andrade is not entitled to damages or attorney fees, as those are only applicable in cases of statutory violations. Since the banks had already provided the records, the legal challenge is irrelevant. Currently, the Fifth Circuit Court of Appeals must decide whether to allow Andrade's appeal to proceed or uphold the lower court's ruling. Andrade's legal troubles extend beyond IRS probe. This case is not the first time Roland Marcus Andrade has faced legal scrutiny. In 2020, the Securities and Exchange Commission, SEC, charged Andrade, then CEO of the NAC Foundation, with conducting an unregistered securities offering. The SEC accused him of misleading investors about AML Bitcoin, a cryptocurrency marketed as an improved version of Bitcoin, BTC. With his past legal entanglements and the current IRS investigation, Andrade faces mounting legal pressure as the government intensifies its regulatory oversight of cryptocurrency ventures. Franklin Templeton's Solana ETF move and SEC's legal strategy shift. Curious about the latest developments in the crypto space? From new ETF filings to legal battles shaping the industry, here's a breakdown of today's top crypto news, including Franklin Templeton's potential Solana ETF, the SEC's enforcement strategy, and a temporary pause in the Binance lawsuit. Franklin Templeton takes first step toward a spot Solana ETF. Global asset management firm Franklin Templeton has taken a notable step toward launching a spot Solana (SOL) exchange-traded fund (ETF) in the U.S. The firm registered a trust in Delaware, known as the Franklin Solana Trust, signaling its interest in creating an investment vehicle that directly tracks Solana's market price. Key details. The CSC Delaware Trust Company was responsible for the filing, a firm known for registering crypto trust products for major asset managers like Bitwise. To officially launch an ETF, Franklin Templeton would need to submit Form 19B4 and Form S1 with the U.S. Securities and Exchange Commission, SEC. If approved, the firm would join major players like Grayscale, Bitwise, VanEck, 21 Shares, and Canary Capital, who are also vying to introduce a spot Solana ETF. Solana has grown significantly in recent years, establishing itself as the fifth largest cryptocurrency by market capitalization. An ETF could provide mainstream investors exposure to SOL without directly holding the asset. SEC requests delay in crypto lawsuit citing new task force. The U.S. Securities and Exchange Commission, SEC, has requested additional time to respond to a motion to dismiss one of its crypto enforcement cases. The agency cited its recently formed crypto task force, which could influence the SEC's legal approach. Latest developments. In a February 10 court filing, the SEC requested the U.S. District Court for the Northern District of Illinois to push its deadline for responding to Cumberland DRW's motion to dismiss from February 19 to March 21. The SEC stated that the crypto task force's work may affect ongoing enforcement strategies and could facilitate potential case resolutions. The agency emphasized that an extension could conserve judicial resources, indicating a possible shift toward settlements instead of prolonged legal battles. This move suggests that the SEC may reassess its aggressive stance on crypto regulation, potentially altering how it enforces compliance cases against digital asset firms. SEC and Binance seek 60-day pause in ongoing lawsuit. In a significant legal development, the SEC and Binance have filed a joint motion to temporarily pause their ongoing lawsuit for 60 days. This marks a notable shift in the regulatory environment and the first sign of a potential resolution under acting SEC Chair Mark Uyeder. Key points from the filing. The motion was submitted on February 10, requesting a 60-day stay on proceedings. The SEC stated that the Crypto Task Force's establishment could impact the case and lead to a resolution. Binance and the SEC both agreed that a pause could save resources and allow time for potential settlement discussions. After 60 days, both parties plan to issue a joint report to determine if a further pause is necessary. This development could have wider implications for other crypto firms entangled in legal battles, including Ripple, Coinbase, and Kraken, which may consider filing similar joint motions with regulators. Conclusion: shifting tides in crypto regulation and institutional adoption. Today's crypto news highlights two major themes. Growing institutional interest in Solana. Franklin Templeton's move signals increasing demand for regulated crypto investment products. Evolving SEC strategy. The agency appears to be reconsidering its hardline enforcement tactics, which could pave the way for settlements and more regulatory clarity. With potential ETF approvals and a regulatory shift on the horizon, the crypto market is poised for significant changes in the coming months. US and UK opt out of global AI ethics agreement amid regulatory concerns. The United States and the United Kingdom have chosen not to sign an international agreement on ethical artificial intelligence, citing concerns that excessive regulations could hinder technological advancements. While 60 nations committed to the framework during a French-hosted AI summit, the absence of two of the world's leading AI powerhouses has sparked debate over the future of AI governance and innovation. US and UK reject AI regulation agreement. At the AI Action Summit in Paris on February 10 to 11, more than 100 countries, industry leaders, and researchers gathered to discuss the responsible and inclusive development of AI. The summit's final statement called for ethical and safe AI deployment, innovation without monopolization, AI's positive role in labor markets, sustainable AI practices, global cooperation on AI governance. However, the US and UK declined to sign the agreement, signaling a clear divide in the approach to AI regulation between North America, Europe, and other nations. US AI regulation could paralyze innovation. U.S. Vice President J.D. Vance strongly opposed excessive AI regulation, warning that it could cripple one of the most transformative industries of the 21st century. Restricting AI now would mean paralyzing one of the most promising technologies we have seen in generations, Vance stated at the summit. He also criticized content moderation, labeling it as authoritarian censorship, and affirming that American AI must remain free from ideological bias. Russell Wald from Stanford's Institute for Human-Centered AI interpreted this as a major shift in U.S. policy. Safety is no longer the primary focus. The U.S. is prioritizing rapid AI innovation over stringent regulations, believing that heavy-handed policies could stifle growth. UK raises concerns over AI treaty language. Unlike the US, the UK's hesitation was more about the specific wording of the agreement. UK officials pointed out that the Paris Summit's AI framework differed significantly from the UK's own AI Safety Summit held in 2023. The British government emphasised that while it supports AI safety, it does not wish to limit AI development through rigid international mandates. The European Union pushes ahead with AI regulation. Despite the US and UK opting out, 60 nations signed the agreement, reinforcing a growing global push for AI regulation. The EU AI Act, which came into effect in August 2023, remains the world's most comprehensive AI regulatory framework. In September 2023, the EU, US, UK, and several other nations had previously signed the Framework Convention on AI, emphasizing human rights and democracy in AI governance. However, after Donald Trump took office in January 2024, his administration scrapped Biden's executive order that had established an AI oversight framework, marking a policy reversal. What's next? The future of AI regulation. The global AI landscape is now divided between those prioritizing innovation and those advocating for stricter governance. With the US and UK choosing a lighter regulatory approach, AI development could accelerate, but at the potential cost of ethical concerns and safety risks. Meanwhile, Europe continues to push for structured AI oversight, creating a regulatory rift that could shape the industry's future for years to come. US, UK, and Australia impose sanctions on servers for alleged support of Lockbit ransomware operations. In a decisive move against cybercrime, authorities in the United States, the United Kingdom, and Australia have sanctioned Russia-based bulletproof hosting provider servers for its alleged involvement in supporting the notorious Lockbit crypto ransomware gang. The coordinated action, announced on February 11, includes asset freezes on servers and its UK-based affiliate, Exhost Internet Solutions LP, as well as travel bans and asset freezes targeting 6 individuals believed to be connected to the operation. Coordinated international effort to disrupt cybercrime. Authorities from 10 countries recently joined forces in a joint operation aimed at dismantling the operations of Lockbit, a ransomware group blamed for causing billions of dollars in damages worldwide. The crackdown comes amid growing concerns over the extensive impact of cyberattacks on critical infrastructure and key financial institutions. Notably, Lockbit has been linked to high-profile incidents, including an attack on Australia's major insurer Medibank and significant disruptions at the Industrial Commercial Bank of China in the US. The US Treasury's Office of Foreign Assets Control, OFAC, and the UK's Foreign Office have both emphasized that providers of bulletproof hosting services, such as servers, play a critical role in facilitating cyberattacks. By offering services that help obscure the identities, locations, and activities of malicious actors, these providers enable cybercriminals to execute attacks on US and international infrastructure with relative impunity. Details of the sanctions and their implications. The sanctions specifically target servers along with its UK front company, Exhost Internet Solutions LP. In addition to freezing assets, the action extends to 6 individuals, including 2 key administrators at servers. Russian nationals Alexander Igorevich Mishin and Alexander Sergeyevich Bolshakov are among those sanctioned. Both are alleged to have been involved in directing crypto transactions for Lockbit and supporting the gang's operational framework. In a statement, Bradley Smith, the acting Undersecretary for Terrorism and Financial Intelligence at the U.S. Treasury, noted that bulletproof hosting providers are notorious for marketing a suite of tools that facilitate anonymity and evade regulatory oversight. Cybercriminals depend heavily on third-party network service providers like servers to mask their identities and locations, thus enabling their attacks on critical infrastructure, he remarked. Blockchain analytics and the trail of illicit funds. Blockchain analytics firm Chainalysis has played a significant role in uncovering the financial trails that link servers to illicit activities. In a report published on February 11, Chainalysis revealed that a crypto address associated with Mission, along with 3 other wallets linked to servers, has been added to OFAC's Specially Designated Nationals (SDN) list. This designation subjects the wallets to special sanctions, effectively cutting off their access to the international financial system. Furthermore, on-chain activity analysis conducted by Chainalysis indicates that servers has processed at least $5.2 million in funds through its network. The analysis suggests that not only Lockbit but also multiple other ransomware affiliates have utilized server services. Additionally, funds have been cashed out via Garantex, a sanctioned, Russia-based cryptocurrency exchange, as well as various merchant service providers and other exchanges known for lax Know Your Customer (KYC) compliance. Bulletproof hosting, a critical link in the cybercrime chain. Bulletproof hosting services like those provided by servers have long been exploited by cybercriminals. These services offer robust infrastructure designed to resist takedown efforts, making them a favored choice for ransomware gangs. Servers, whose homepage lists server locations across the US, Russia, Bulgaria, the Netherlands, and Finland, advertises itself as a provider of comprehensive support, equipment, and tailored configuration services. Such capabilities enable cybercriminal groups to conduct operations with minimal risk of exposure or interference. The sanctioning of servers represents a significant step in international efforts to curtail the activities of groups like Lockbit. By targeting the service providers that enable these operations, regulators aim to disrupt the financial flows and logistical support networks that underpin modern ransomware campaigns. Lockbit, a persistent cybersecurity threat. Lockbit, which was first detected by authorities in September 2019, has emerged as one of the most formidable ransomware gangs in the cybercrime landscape. Over the period from June 2022 to February 2024, the group is estimated to have executed more than 7,000 cyber attacks, extorting up to $1 billion in ransom payments from victims worldwide. Lockbit's modus operandi involves encrypting critical files and then demanding cryptocurrency payments to unlock them, with the constant threat of data leakage should victims fail to comply. The extensive damage attributed to Lockbit has galvanized international efforts to clamp down on its operations. The recent sanctions against servers are part of a broader strategy by governments and regulatory bodies to tackle the infrastructure that supports such cybercriminal enterprises. Global impact and future prospects for cybersecurity enforcement. The joint operation, led by authorities from 10 countries, underscores the growing global consensus on the need to combat cybercrime more aggressively. As cyber attacks continue to escalate in both frequency and sophistication, measures such as these sanctions are expected to serve as a deterrent for other malicious actors operating in the digital underground. In addition to the sanctions, there is a push for greater international cooperation and improved regulatory frameworks to address the challenges posed by cyber-enabled financial crimes. This includes enhanced oversight of digital asset transactions, tighter controls on bulletproof hosting services, and better coordination between law enforcement agencies across borders. With the international community united in its efforts to disrupt cybercriminal networks, the hope is that these measures will significantly reduce the operational capabilities of groups like Lockbit. While the effectiveness of these sanctions remains to be fully seen, they mark an important milestone in the ongoing battle against cybercrime. By targeting both the facilitators and the financiers of cyberattacks, governments are sending a strong signal that no aspect of the cybercrime ecosystem will be left unchecked. As investigations continue and further actions are taken, the landscape of cybersecurity enforcement is likely to evolve, with increasingly sophisticated measures aimed at safeguarding critical infrastructure and protecting the global financial system from digital threats.